In this piece, we take a look at the quality of financial statements. Continuing on, what is IFRS and what are differences between GAAP and IFRS? As you know, there are many companies that do business around the world, and everybody may use different accounting practices. It's important to know some of the key differences in what IFRS is and such. So the first thing, when we look at international financial reporting standards, this is a piece, this framework that I really like. And it all starts with an objective. And the objective is to provide information that is useful to current and potential providers of resources in making decisions. So that's at the core of IFRS. All other aspects of the framework flow from this central objective. When we look at it, there's two pieces here there's qualitative characteristics. And the first two that I'd like to look at is relevance. Information that could potentially make a difference in a user's decision. Well, the next one is a faithful representation that represents the economic phenomenon that is actually occurring. And ideally, it's complete, neutral, and free from error. So these are the qualitative characteristics of IFRS: relevance and faithful representation within the context of materiality. When we look at some of the other qualitative characteristics, we get comparability. Companies record and report information in a similar way, so we should be able to compare companies. Verifiability. Independent people using the same methods arrive at a similar conclusion. Timeliness. Information is available before it loses its relevance. Okay? Something after a year or two after the fact doesn't help. Understandability. Reasonably informed users should be able to comprehend the information. So now that you've gone through Corporate Finance 311 and you're coming to the end of financial statement analysis, you should be able to understand the information and comprehend it because you're reasonably informed. So these are the characteristics, the objectives that go around that. We look at a couple of other things. There's an underlying assumption here, and that's accrual basis, where we recognize revenue and expenses in the same period in which they occur. And the second is that it's a going concern. The business is likely going to be able to continue. The next thing is you have the performance, and that's your income, expenses, capital maintenance adjustments, and cash flows. And then there's the financial positions, assets, liabilities, and equity. So that's the framework of IFRS. When we look at the general features of financial statements from both an IFRS and a GAAP perspective, we have the fair presentation, going concern, accrual basis, materiality and aggregation, putting things together to make meaningful, no offsetting. Okay, that becomes important. You don't offset a debit you don't offset necessarily a asset item with a liability. Frequency of reporting, there has to be that consistency. Comparing information over time. That becomes important so you can identify trends, which you've already done. And then consistency. Okay. What we have is when we look at IFRS, and this is where it can be a little bit different in European, one is classified. Balance sheets required in the U.S. to be broken between current and non-current, and current and non-current liabilities. Unless a single format based on liquidity provides both relevant and reliable information. When we look at foreign IFRS, they start with intangibles and other assets and work down to the more liquid assets. Minimum information on the face of the financial statement is very clear. You've seen that already. And then most everything should be in the notes. Minimum information in the notes. There's some very specific things that you have to disclose. If you've read some of the notes, you're already there. Comparative information, prior period is always recording. This is under IAS number 1. A current coherent financial reporting framework, which we talked about, it's transparent, it's comprehensive, and it's consistent. We can see it, it covers everything, and it's applied from period to period. Barriers, and there are barriers to creating such a framework, and I think some of you have already seen this. Valuation, alternative measurement approaches, Kraft Heinz. Standard setting approach, a balance between principles and rules, and measurement. Do you focus on the income statement or the balance sheet? I don't think it's that clear, because the balance sheet tells us what resources the company have, what are their current, and what is the equity in the company, which is important for its future survival. But understanding what has happened in the past, management implementing strategies, so it's a balance. Disclosure, pretty straightforward. They're required to disclose their accounting policies and estimates that are used in the financial statements. In the management discussion, MD&A, management discusses those that are most important. And if you've read the investor presentation in the management discussion, you will see that. Some of the policies are so important that they're discussed both in the management commentary and the notes. Companies have to disclose the information about changes in estimates, changes in accounting practices. That has to be disclosed. Now, a couple of things to be aware of. There's 3 that we're going to look at, 3 very specific differences between IFRS and GAAP. One is IFRS does not allow for the use of LIFO, last in, first out costing methodology for inventory. It is permitted under US GAAP. Now, last in, first out, if you think about something, think about you're working in a grocery type store and you put milk in, you always would move the milk forward, so the one with the most current date is up front, and the one that has the longer date, those that were the last ones received, in the back. So you're always selling the first in, first out. However, for U.S. tax purposes, this last in, first out is used. It generally, assuming a rising rate environment and in somewhat a level of inflation, this would result in a higher tax deduction and an inventory that's closer to a market rate than that. The one restriction the IRS has is that if you use this for tax purposes, you have to use it for financial reporting purposes. So without the change in the IRS rules, eliminating LIFO from US GAAP would in effect eliminate its use for tax purposes as well, which doesn't work. So we could have an inventory issue as to what is being pushed. And again, if you have a decline in costs, the reverse would happen. Measurement of certain asset classes. Under IFRS, certain assets, capitalized, acquired intangibles, and property, plant, and equipment are initially recognized at cost. Okay. For subsequent measurement, the entities have a choice to continue with the cost model or to revalue the assets within each class, less any accumulated amortization and depreciation. Okay. And if you really look at this as acquired intangibles, very specific, property, plant, and equipment. That's the big one. US GAAP does not allow you to go in and revalue fixed assets. Okay? And think about this for a second. So if you revalue them and the market value of that property and plant equipment is higher than when you bought it, you would recognize a gain under IFRS. Okay? So under GAAP, we wouldn't write up an asset. Okay, we wouldn't revalue those assets. We'd simply continue to depreciate them. So you could have a gain on IFRS, nothing on GAAP. Now, when it comes to the value of intangibles, both systems require that you do a periodic examination and you write down, but you never write up. under GAAP. IFRS you could write up. Impairment. The IFRS model allows for reversal of impairments up to a certain amount if there's an indication that impairment loss has decreased. Once you book it in GAAP, you don't reverse it. Okay, so in the banking business, you provide a provision for or reserve for loan losses where you anticipate future losses on your loan book. Okay, in Europe and under the IFRS model, you can recoup some of that if there is an indication that the loss has done. In the U.S., we can't do that. And this SEC staff, and this is where you come back, is just, it's not GAAP, but they believe that a distinction could result in differences in the timing and extent of when you recognize them. U.S. issuers could experience greater volatility if the IFRS model was incorporated, flowing recoveries of properties previously written down. So if you're looking at it, GAAP effectively keeps property, plant, and equipment at cost, where under IFRS you actually mark it up and down to market, so that you're going to have more volatility. Certain non-financial liabilities, and this comes in the recognition of certain non-financial or contingencies. We don't know what's going to happen. Is governed by the probability that a liability has been incurred under both GAAP and IFRS. However, they define the definition of what is probable is different. So if we come back and say, okay, probable, the first step, remember, is it possible? And if it's possible, is it probable? Okay, because if it's not possible, then it's not probable. So when we look at it, IFRS says more likely than not to occur. Okay, the future events are likely to occur. More likely than not, likely to occur. Likely is a higher standard than more likely than not, meaning US GAAP has a higher recognition threshold than does IFRS. Therefore, when you think about it, liabilities will be recognized earlier under IFRS than US GAAP. So we need to be aware of that as we are moving forward and you're doing more complex analytics.